I should put myself in here. Good afternoon and welcome to Seattle's Eastside Real Estate, Seattle's Real Estate Podcast. We dropped the Eastside because we are the greater Seattle area. I am Dan. I'm your host, managing broker with Seattle's East. I'm going to have to work on that. Seattle's Real Estate Podcast. And I'm going to bring in our good friend, Tucker Maxwell with Gill Mortgage. Hey, how's it going, Tucker?
Good, Dan. How are you?
Good. Hey, what's your sweatshirt say?
It says, be a good person.
Be a good person. That's a great thing to tell me. Thank you. I appreciate it. I need that affirmation. Tucker and I were talking, and we are going to do kind of a quick crosstalk on our real estate topic today. Our real estate topic is, let me get into our Real Talk segment before we get into that. It is, Wednesday, February 7th. This is a last minute podcast, so forgive me for not being super prepared, but I think the content that we have is going to be awesome. So let's get to our real talk. All right, so welcome back from that short bumper. We are going to talk, the topic today is 5 reasons why a home would stay on the market. Now, we've been talking about inventory and inventory levels for many years on this podcast. And one thing that we know is where we're at right now is about 1.25 month worth of inventory. And that's in most neighborhoods around the greater Seattle area and the east side. There are some areas where maybe it's a little longer, a little more when I say a month of inventory. But the truth of the matter is a lot of homes are going fairly quick, but there are a few staying on the market. Have you seen that, Tucker?
Yeah, absolutely.
Yeah. And so one of the things that we'll do when we're out there touring with somebody, we're looking at the homes and they may wonder, what are some of the reasons why they stay on there? So I did an informal poll. I went around our office here today. We've got a lot of great real estate agents, and we talked about our top 5 reasons why a home would stay on the market. And we're going to start with number 5 and we're going to work to number 1. So kind of like that top 10 list that Dave Letterman did. So tell me what your thoughts are. Number 5 is functional obsolescence. Have you ever heard of that term before, Tucker?
I believe, yeah. I think of it with cell phones.
With cell phones, yeah. Well, that's a process whereas they make sure that these screens are super fragile and they crack, and after about 1.5 years, you got to buy a new one. But in a house, it's actually a situation. I guess the easiest way to describe it is we had a design feature back in the 70s called split entry. Right. And a split entry was a design feature that when you walked into the house, you had to decide whether you go up or down. Right. Mm-hmm. That's the split entry property. Now, that's not considered functional obsolescence, but to some buyers, they're turned off by it. They're like, I don't want to have to decide. I want to walk in on the lower level and walk upstairs to their bedrooms. But another story that I have around this is when homeowners remodel, oftentimes they'll remodel in a way that's very customized to them. So let's say they decide to put a wet bar in the family room, right? And maybe that's not something that works. Or sometimes some of these split entry homes, the downstairs was unfinished. So the owner goes ahead and compartmentalizes that basement, and it creates a spot, a floor plan, if you will, that isn't conducive to how current homeowners live. And I always tell the folks that are touring the home, when they look at it and they go, why did they do this? I said, just remember, that was their best thinking that got them to doing this. I have seen a stacked washer machine in a kitchen in the downstairs area where they created a space that now is pretty constrained because they're trying to get the most out of the space. So if you look at a house, the number 5 reason was that functional obsolescence is somehow they designed the home. Instead of being more of a great room, it's more of a compartmentalized, and that may cause that home to stay on the market when a lot of people are looking to live a little differently. So that's number 5. Number 4 is a poorly cared for neighborhood or HOA. That's one of the things that isn't necessarily visual, like when you show up to the house, right? You're looking at the house, you're wondering online, right? You got some great pictures, you got some great kind of, master bedroom, master bathroom. But then the story is when you drive into that neighborhood, it's the best house on the block or the biggest house on the block. or it's an HOA that's poorly managed, which means that doesn't show up in the pictures. It doesn't even show up in the tour of the house. It shows up in the financials, where they have some delayed maintenance that has to be done. And not all HOAs, I think we have to state this, like there are some really well-run, there are many well-run homeowners associations where the money is used well. But there are some where that home is going to take longer to sell. And I would even add this, Tucker, some of them may be unfinanceable. Tell me about that part.
Yeah, absolutely. So that's a really big piece, especially with condo associations right now, is not just on VA and FHA, even conventional loans now want to look into the financials of the HOA to determine the likelihood of a potential assessment. That's really what we're looking at, is if we're, you know, qualifying a borrower off of their debt to income ratio and assuming a HOA fee, we don't want to have overlooked the fact that they may get hit with a huge bill because of this deferred maintenance or something like that. Or it could be health and safety things. Like we've had an association where the electrical box wasn't secured properly, and it was the HOA's responsibility to fix that, and we were unable to lend on that because of it.
Yeah. So that's one of the things. And there are some others, like you could probably look at from a house standpoint. If a house is on the market and it doesn't say in the description that it's cash only, it could be that the heating system is not existent. I mean, it's the five major: the roof, the envelope or the siding, foundation, plumbing, electrical. Like those five things, if those aren't complete, it may be that home is not financeable. Which means it's going to stay on the market a little longer. Number 3 of the 5 reasons why a home would stay on the market is not as advertised. I thought this was an interesting one. This is one of our agents here. Tina had said, yeah, you show up expecting a 3-bedroom and what you get is 2 bedrooms and a closet, right? So as I always tell my sellers, as we look at a home, we want people to be surprised rather than disappointed. So if we have a 3-bedroom home, technically, because all you really need now is, you can just say it is. There is no legal definition in our MLS for a bedroom, but typically it used to be what we call egress, which means going out a window, and a closet. Nowadays it's just whatever you want to call it. But I would look at it and say it's 2 bedrooms plus a bonus room, right? And that way, when somebody showed up, comparing it against other 2 bedrooms, they see an opportunity to put their 3rd child in that or something like that. So not as advertised. And I think
Can I add something there?
Yeah, please, of course.
I think appraisal is a big question mark there too. When we see it and it's being advertised or marketed as a 3-bedroom and they're trying to get that top dollar for it, but if that room is not a bedroom or the appraiser doesn't feel it meets what a bedroom is,
that's a good one.
Dock it, and then you could have an appraisal gap scenario. So we always say, like, especially on remodels and renovations, if the permits weren't pulled or if it's not actually a bedroom and you mark it as such, you run the risk of having an appraisal issue.
Yeah, let me add something to that too. Is had a flipper company that decided to put a house together, and they bought a split level. Wow, we keep coming back to that. They had 2 bedrooms up and 3 bedrooms down, and they decided to make they had 3 bedrooms up, and 2 down, and they decided to flip that and to make 2 bedrooms with a nice big master, right? Yep. And then another bedroom upstairs, and then the 3 bedrooms down, because they had space for it. And their appraisal came in low because of the below grade square footage.
Yep.
So they were calculating 2 bedrooms above grade and 3 bedrooms below, whereas they were trying to compare it with 3 bedrooms above grade and 2 below. So yeah, you got to definitely understand the ramifications if we're remodeling a house to the value. We were able to get over that hurdle, but it's definitely one. So poor condition. This one actually, I think, is another one of those items that can be really, so not as advertised and poor condition are 2 that I think real estate agents have a bigger influence over. Functional obsolescence, you can't do a lot about. Like a house that's missing, a furnace and stuff like that, can't do a whole lot about. But the poor condition is all about staging, getting the house ready, properly understanding that if you're going to put a property on the market, you detail it. Have you sold houses before, Tucker?
No, I've actually Never sold any of my properties. I own them all
Just,
still to this
just,
day.
just keep buying them and buying them and buying them. That's good.
Yep.
But yeah, have you sold a car?
Sold car, yeah, and been involved with family members and a lot of clients that have sold homes. So
Yeah, and it's about wanting to put that property in its best possible light. And I have to say, I've seen many real estate agents make this mistake out there in just getting it on the market. You know, it's a hot
yeah,
market, go right ahead. And I have to say that inevitably ends up with a bad experience for the seller and in a poor taste in their mouth. And one of my pet peeves is odors. When you walk into a house, it's a small thing, but you got to make sure that house smells good. And the bigger pet peeve to stack on top of that of odors is cover up odors, right? You
exactly.
know something smells bad, and then you throw a couple of Glade plugins in there, and you're just like, oh, that just hit me in the face. That's just me. Maybe other people are fine, but I'm a big olfactory person.
Well, it's the first impression. As soon
Yeah.
as you open that door, that's what hits you. You can't even look at anything else yet.
Yeah. I remember one place like sour milk. You know, somebody had taken the gallon out of the refrigerator and just put it in the garbage. And it was like open and warm and heat hitting it. And that was just like the first thing that hit my nose. Of like, oh, no thanks. So can you guess what the number one reason why a home would stay on the market in longer in this time?
Do you want to guess?
Yeah, see if you can guess.
Inaccurate pricing.
Yeah, I think inaccurate pricing. Yes, that one I had to cross off because everybody out here in the office was like that. Yeah, inaccurate pricing is a really polite way to put it. We put it as overpriced, but a lot of times we're trying to look in the rearview mirror to determine, especially in a market that has not a huge level of inventory turning over on a regular basis. So it happens where you put a house on the market or the market shifts or it changes. But I think a carefully priced, prepped property should be able to move fairly punctually. Well, I don't know if that's the right way to say it. I was just trying to add another
Yeah,
P.
it
Punctual
works.
is on time, but
Yeah.
yeah, I'll have to come back to that alliteration. That was not good. So there you have it. 5 reasons why: the overpriced, poor condition, not as advertised, poorly cared for, or functional obsolescence. Those are 5 reasons. We're going to take a quick commercial break, and then we're going to chat with Tucker about the various mortgage products. I thought it would be a good time to re-summarize these as we're kind of heading into a environment where it does matter what product you select. So we'll be back after this short commercial break.
The pest stops here. Green City Pest Control is your full-service pest solution for all your pest control needs. With an owner with 32 years experience, a board-certified entomologist, and rodent specialist, we do it all. Bats to rats, crawl space, or attic. Call us and we will resolve your problem. 425-413-9700.
All right, welcome back to the show. I'm your host, Dan Edwards, managing broker for the Eastside Real Estate Team, and you're watching Seattle's Real Estate Podcast. And I'm here with our good friend Tucker Maxwell, Guild Mortgage, and we're talking about loan products and the difference between them. So you want to set the stage here?
Yeah, there's a lot of different options. I think you nailed it. There is a lot of options, and we use them in different situations for different outcomes. You know, payment sensitivity, cash to close sensitivities, and cash to close is the amount out of pocket that somebody would bring in to buy a home, whether or not they've served in the military or not. Are they buying rural property? What is the value of the home? There's a million variables that lead us to a number of different loan solutions.
Okay, so I get a report from you once a week, kind of talking about where interest rates are. And the one thing I noticed, I was just trying to pull up my report that you sent me this morning, is I'm noticing a pretty big difference between a conventional loan rate and a FHA loan rate. Can you kind of share with me why that's the case?
Yeah, so and the same with VA. FHA and VAs right now are quite a bit lower than conventional. And it just has to do with the nature of those loans. With those loans, you have a secondary kind of backing. The VA or the Federal Housing Administration is going to back those loans. So there's less risk to the lender when offering those solutions. So they tend to be slightly lower than conventional, because on a conventional mortgage, usually it's just the one servicer, Fannie Mae or Freddie Mac, that's carrying the full default risk on that loan.
Okay, so based on the risk to the lender, they see that if you qualify as an FHA, your risk is lower, or you mean the other way around, because it's backed by the federal government. They give you a little bit better rate because they figure it's going to be more backed by the government. I don't know if I understand the difference there.
Yeah, so rates are always a reflection of the risk the borrower presents. And so that's why it's individualized to every applicant. And so on an FHA loan, yeah, we're assuming that maybe they have less down payment because they can go down to 3.5%. But with an FHA loan, you have an upfront mortgage insurance. So we're saying, hey, Dan, if you want to buy with FHA, you can, but you have to give us a few more dollars today in order to do so. Plus, we're going to charge you monthly mortgage insurance for the life of the loan. We're going to collect off that. So the interest rate isn't as important because we're getting those funds upfront in the upfront mortgage insurance premium and the monthly mortgage insurance. And
Okay, I missed
right
that.
now.
So can't you do FHA 20% down?
You could, but you still have mortgage insurance.
Oh, is that right?
Yeah. So let me preface that. There are some areas where you wouldn't, but in most situations, an FHA is going to carry mortgage insurance.
Okay, so now let's talk about the VA, because is there mortgage insurance with a VA loan?
There's not.
Aha.
0 down payment requirement, so they can do 100% financing, and there's no monthly mortgage insurance. However, there is a VA funding fee, and the VA funding fee is a percentage of the loan that has to be paid, and it's just like the upfront mortgage insurance on the FHA loan. It's a funding fee to the VA to hedge against defaults, so they're collecting that from every borrower. The cool thing about the funding fee is if we have to check into the veterans status when they left the military, did they leave in good standing, and what is their level of disability? And depending on that, they may be exempt from that funding fee.
Oh, okay. So there's definitely things that go in there. And I like kind of unpacking this because we're kind of talking a little bit about different things, right? Because it's not just one thing that causes you to get one rate. Right. And again, it's not just one thing that causes you to get different funding fees, right? Yep. So if you were to break down, and I don't know if it's a generality, but conventional versus FHA versus VA, is there a specific 1 percentage point, 2 percentage points? What is it?
No, it's variable. Yeah, it varies all the time, and that spread changes as well. Right now, why you're seeing that there's a bigger gap is on conventional mortgage. We're really concerned that those people are going to refinance right away. Mm-hmm. Right? Interest rates drop right away, and we just did that loan. We might not have had time to recuperate the
cost of
revenue, the cost of doing the transaction. Whereas with those other products, VA, FHA programs, we get those funding fees. So at least we're covering the expenses with the fee, and we're not concerned as much with a quick refinance after that transaction closes.
That's great. So if you were to say, as we're looking at this market, you and I have talked about the numbers, we've looked at them, analyzed them. Next week, we'll probably dive deeper into January's numbers and what that translates for this year, because I don't have them yet. But it looks like the spring market's starting early. Would you agree?
Yeah, absolutely.
And then I think because we're in an election year, we're probably going to see a slowdown right around September, October, right? So that means we're going to have a condensed market, and there's still a lot of demand. What do we need to do for a buyer that is kind of, hey, I'm planning on doing something? What preparations should they make now?
Yeah, I would get fully underwritten. I would get a pre-approval going and understand the numbers. This is a really big question right now, is trying to time the market. The Fed has alluded to some decreases. We saw a little bit of those decreases in rates to start the year. They've sort of bounced back up a little bit in the last 5 days, but nobody really knows. You mentioned two things. You mentioned the election and you mentioned the summer buying season. They're going to have to consider all of those things when thinking about decreasing rates. And for our market, specifically in the Seattle market, if rates start to come down, it's going to get ultra competitive overnight, even more so than we're already experiencing. And so for that buyer that's kind of toying around, like we may buy this year, I would say get your ducks in a row, get things dialed in. So if the right home presents itself, you can move quickly. And worst case scenario, you've gotten your pre-approval ready and it just waits for you to be ready. You win the right home. So it doesn't hurt to get pre-approved.
Okay, so let's say somebody gets pre-approved and rates drop, but they still haven't identified their house. Is there any way to lock in that rate?
They can, yeah. We have programs specifically at Guild. We call it lock and shop. So we can lock a rate in for 120 days. They get those 120 days to go out and shop for their home, and they don't have to worry about the lock.
120 days.
Yep.
That is 4 months.
Roughly. Yep.
So 120 days. So essentially, in order to be able to lock, what do they have to do?
They have to be fully underwritten. So you have to have a credit approval, so credit report, all of that. And then
verification of employment, all that stuff.
Yeah, full doc package. So 2 W-2s, 2 bank statements, 2 tax returns, all the works. Full credit app, and then we lock. There is an upfront lock fee, so we have to hedge that. We are telling Fannie Mae, Freddie Mac, like, hey, we're going to deliver this loan sometime in the future, and so there's a lock-in fee. With our lock-in fee, there's an upfront fee that is not refunded if they just go away, but if they do close on a transaction, it's credited towards their closing costs.
Okay, and what's that fee?
It's $1,500 the last I checked. We weren't really doing that. We stopped doing it when rates started to come back down. We stopped. We were like, let's wait it as long as we can. But in 2022 and all through 2023, we were always talking to clients about a potential lock and shop scenario.
Yeah, and I think the conversation here is the conventional wisdom, professional wisdom is a better way to put it, not conventional. Professional wisdom is that we're going to see rates kind of go down and then like bouncing around in the sixes. If we get below 6 and you're like, okay, I know we're buying something in the next 4 months, you're going to pay that $1,500 and it's going to save you. Do the math, whatever that looks like. It may not be significant enough. But if the one thing is true is if you're not fully underwritten, you can't write an offer on a house because you're going to lose out in a competitive situation. So just go ahead and get fully underwritten.
Exactly.
Way to go. All right. So Valentine's Day is next week. My assumption is that you've got the missus all taken care of. Is that right?
Yep. I got a little date night planned for the 14th.
Very nice. Excellent. So of the years, is it usually date night? You go out to dinner? Do you guys have a favorite place in Seattle that you like to go?
Yeah, we do. We're doing something a little bit different this year because my wife is a big Bob Marley fan. And so we have to go see One Love. So we got, premiere tickets to see One Love. And then we're going to Vino at the Landing.
Vino at the Landing in Renton. Is that a new Italian place?
I wouldn't call it Italian. It's a wine shop, but they have a really great kitchen. And they actually had an unfortunate event, 4th of July last year. A firework caught the Landing on fire. I don't know if you're listening.
I didn't know that.
Yeah, and so Dozone, a number of restaurants had to close down, and so Vino just reopened, and so we're gonna go check out their reopening and do Valentine's Day there.
That sounds cool. Yeah, one of my favorites in Issaquah is Moltecino. I don't think if you're planning your Valentine's Day right now, folks, you're listening to this, it's a little late. Hopefully, you're going to come up with some creative ideas. But Moltecino's is a fantastic Italian restaurant, great spot, romantic spot. Yeah, that's all I have for today. I think it's great. I mean, obviously we've got some tips for sellers and some tips for buyers. Let me see. I'm going to flash Mr. Going to add your phone number on here. I know it's right there. So you can get a hold of Tucker, 425-757-9202. You can find him. Just Google Tucker Maxwell Guild Mortgage. You'll find him. You can apply online and get everything right. If you're working for Microsoft, you work for Google, streamlined process, right? Pretty quick.
Absolutely. Automated verifications. We're pre-approving tech borrowers within minutes. So that's easy.
All right. Well, thanks so much for watching Seattle's Real Estate Podcast. We hope you enjoyed it. If you know of a local business on the east side or in Seattle that'd like to be featured, we're going to start re-adding features back in here, and we're going to be a little more flexible in how we do it. I think we might pre-record them and then shoot them in here. Haven't really decided, but it should be good. Have a very, I guess we'll see on Valentine's Day because that's next week unless something comes up. And I am like stalling because I'm trying to find my outro. And it's around here somewhere there it is right there. So thanks for watching our podcast. Have a wonderful week.